So the first thing I wanted to compare these two on is revenue growth, and I wanted to go all the way back to 2019, where they started with 200 million and 100 million in revenue, respectively. So Monday.com has grown its revenue from 100 million, more than 10x to 1.1 billion since 2019. That's good for a compounded annual growth rate of 61.7%. That's one of the best growth rates of any of the companies I've been following in this amount of time. Fastly has grown its revenue 3x from 200 million to 600 million in that time. That's good for a compounded annual growth rate of 21%, which is really good, but it looks mediocre when compared to Monday, which has nearly tripled Fastly's growth rate in that time. Perhaps more impressively, Monday's revenue growth has led to significantly improving profit margins on the bottom line. Monday's net profit margin improved from negative 117% to 3.6% in the most recent trailing 12-month period. Meanwhile, Fastly's profit margins have been volatile in that time, but stayed flat from 2019 at 25.7% and 25.8%, all negative in this time. So not only is Monday.com generating significantly better revenue growth, but it's also generating significantly better improvements in profitability and an overall better net profit margin. The next thing I wanted to compare these companies on is the return on invested capital. This measures how good a company's management team is at taking investor money and turning it into products and services that generate profits and cash flow. Now, you might be saying, well, these companies don't go to investors and ask for money all that often. And you might be right. But even if a company doesn't go to investors and ask for more money, it doesn't mean that it's not using investor money. And the reason for that is, as an investor, as a shareholder of the company, you're entitled to a percentage of the profits that the company generates. So if the company generates $100 million in profits and it doesn't pay any dividends, then basically it's taken $100 million from investors, because that money belongs to investors. And rather than returning the capital to shareholders, it's keeping it to reinvest in the company. So the last thing I wanted to compare these two on is the forward EV to sales ratio. So this is the enterprise value, which includes debt, and divided by sales expected over the next year.
Click the link below to watch the full video.